The Chinese government is thinking very much about treating capital well.
According to two significant Chinese clearinghouses, foreign investors have taken more than 100 billion out of the Chinese bond market since February. They've also significantly reduced their stock market interest. Cathie Wood, who oversees nearly 20 billion, was quick to realize the suffering that the world was going to experience. Now, according to economists, the US GDP growth is outperforming China's for the first time in nearly 50 years. What is actually happening in China then? Join us as we discuss Cathie Wood's predictions on the Chinese economy and how it all comes apart. China's economy saw tremendous growth once it started to open up in 1978. Its GDP increased by 10% annually on average, and as a result, citizens of China experienced significant prosperity, providing the opportunity for 800 million plus individuals to overcome poverty. Education was given priority, healthcare made enormous strides, and technical advancement was quickened. And in a few decades, China has developed into a manufacturing powerhouse revered by all economists as a result of its unequaled growth. But as you are all aware, nothing comes for free. China's rising debts were the main cause of its unmatched prosperity. Those that took out loans saw their net worth increase quickly during periods of strong economic growth, and this encouraged others to follow suit, accelerating the economy's growth. The cycle provided a constructive feedback loop that led to exponential expansion in China. This technique has been effective for many years, but China's debt has reached an unsustainable level. Over many decades of prosperity, China's government debt to GDP ratio climbed to over 66%. Along with this trend, the total public debt in China has increased to almost 300% of the GDP. This is about double the US non-financial corporate debt to GDP and nearly 60% higher than the global debt to GDP ratio. China's recent problems show that such a big number of liabilities is unsustainable. According to China's National Statistics Agency, consumer prices increased 1.8% in December compared to a year earlier, which is a quicker rate than the 1.6 annual rate seen in November. As people bid up the price of travel, medicine, and other in-demand products and services, and as businesses have faced production delays brought on by waves of illness, economists anticipate that the lifting of China's harsh COVID restrictions will increase inflation in the nation. The question for the world is how much pressure the reopening of China will continue to put on world prices. As a result of China's economy roaring back to life, prolonged global inflation could delay to the point at which central banks can curtail or even reverse their aggressive interest rate increases. Due to the severe COVID laws, banks and economists around the world have been consistently lowering their GDP prediction for China. More crucially, the crackdown on heavily leveraged businesses in China may trigger the opposite of the positive feedback loop we previously discussed. When borrowers miss payments on their loans, the economy contracts. More people default as a result further down the economy. President Xi has been enforcing a plethora of regulations for this campaign with the sole purpose of promoting common prosperity. Real estate is one of these industries. Prices for real estate are the pinnacle of exceptional affluence. A disproportionate percentage of capital appreciation from growing real estate values has gone to investors. So by enacting new property taxes, Xi is aiming to crack down on this. The 3 red lines policy is another measure Xi has put into place to crack down on real estate. The maximum amount of debt that real estate developers are permitted to have is capped by the 3 red lines. On one hand, housing prices are falling at incredibly rapid rates as a result of all these strategies. On the other hand, the number of sales of newly constructed homes is also declining. Yikes! Early May 2022 saw a 33% decline in new home sales across 23 major Chinese cities. A quarter of China's GDP is made up of real estate. Therefore, a 33% decline in home sales would cause a 9% decline in China's GDP. The Chinese government is taking every action at its disposal to stop the company's further collapse because it is aware of the approaching calamity. China's government has been lowering interest rates while the US Federal Reserve has been raising them in order to save its economy. The current prime rate for consumer and business loans in China is 3.7%. With time, it is only anticipated that this number will decrease even further. The nation just reduced its prime rate for 5-year loans by the most since 2019. Europe likely has a recession. If we examine China's microeconomic data, we will see that it is really incredibly weak. Therefore, everything depends on the US. Therefore, I believe that supply shocks are weakening purchasing power, and I believe that much of what we are currently witnessing is a result of supply chain dynamics and supply shocks, which are also highly cyclical. But it also means that some Asian economies are tightening up more as a result of the depreciation of their currencies in relation to the dollar. It's somewhat of a vicious circle then. Many people consider the United States in isolation. The majority of people dismissed the first quarter of negative GDP, saying, "Oh, that's just a fluke." But note that in 2021, China accounted for more than 18% of the global GDP. Therefore, a sharp decline in China's economy would weaken the entire world. Added to the fact that Europe's economic development is slowing, and it is evident that we are in a worrying situation. Cathie compared the Fed's decision to raise interest rates to playing with fire because it can make global problems worse. For the first time since 2019, the US bond curve has inverted, which suggests that a recession may be on the horizon. When the yield on a 10-year Treasury bond is lower than that of a 2-year Treasury bond, the yield curve is said to be inverted. When the interest rate for a shorter time period is higher than the interest rate for a longer time period, this suggests that the risk is larger in the short term than in the long term. Simply put, bond investors anticipate suffering a great deal. Most of the time, recessions are preceded by an inverted yield curve. China and Europe are in a precarious situation. The Fed appears to be putting itself in danger. Right now, the world's economies are exceedingly weak, and a collapse of the US economy would send them all into unimaginable misery. We'll observe that in real time, which affected a wide range of nations occurred in 2008. However, the 2008 recession was not as severe as the current crisis. China's GDP continued to rise by double digits throughout the worldwide recession of 2008. Africa, Australia, and the rest of Asia didn't see their respective GDPs significantly fall either. In contrast to 2008, the bulk of Asia, Europe, South Africa, Australia, and America is in distress now. Also note that the Chinese government is not known for its transparency. China is infamous for providing fake economic statistics that hide financial crisis and overstates development. According to Cathie, the real data in China would indicate even more dramatic decreases in sales in the real estate industry. She thinks that might ultimately result in a short-term decline in oil prices. It is that a big downturn in China will also accompany a recession in Europe. Given how hard they've struck their property sector and how much pressure they're putting on the economy overall from a regulatory standpoint, of course, given the kinds of shocks we've had, anything is now imaginable. So how should investors therefore prepare their portfolios to weather this slump in light of all this information? Holding cash is one easy strategy to keep afloat, but doing so can deplete your money due to inflation. The US dollar is still holding up reasonably well despite undergoing substantial inflation. The dollar index measures the dollar's strength in comparison to other currencies. Despite significant inflation over the previous year, this indicator has been rising. Even if a big slowdown in inflation may cause gold prices to fall, gold investment could be a great hedge. Diversification among the best assets would be the best strategy in this situation to reduce volatility while maintaining favorable returns. The dollar is strengthening, and I do think there is a reason based on the terms of trade. China might have gotten more anti-capitalist, Europe is in recession and edging closer to war, and right now, it just seems safer to be in the US. Investing in publicly traded growth stocks could be profitable if you're willing to take on more risk for greater returns. We are all aware of the severe decline in public growth stocks with ARK Invest garnering the most media attention. This has created a wide range of chances to earn 10 or 20 times returns over the coming several years. Public growth stocks are incredibly volatile, so only invest if you're ready for your portfolio to trend down in the near future. How long do you think it would take for China to recover from this crisis? Let us know in the comment section below. If you enjoyed this video, please hit the like button and subscribe, and we'll see you in the next one.